Okay, well, Mark Matthews of Bank Julius Baer and Company is with us. Mark, good to have you with us here on the program, Prashant, this side. Markets, in a way, kind of unbothered, so far at least, with regards to the tariff news flow, which was all that was singularly driving markets around Liberation Day, pre and post that. But now, not so much. What's your sense, Mark? And start with this 1st of August date which Secretary Besant put out over the weekend, saying, well, tariffs will go into effect on the 1st of August. So actually, in that sense, you have a de facto kind of extension. In any case, as I was saying, markets were kind of thinking, well, this is largely symbolic and there will be extensions if necessary. What's your sense?
My sense is that the tariff talk is vastly exaggerated, and there's no better indicator of that than Walmart's share price, which is less than 6% away from making a new high. Walmart is obviously where all of these imported goods are sold to consumers in America. It wouldn't be 6% from an all-time high if the tariffs were going to be the kind that Donald Trump held up on his whiteboard on the 2nd of April that Besant says countries are going to get hit with on August 1st unless they do deals. So I think either that means there will be deals done in between now or then, or there'll be extensions. But one thing I would like to let you know, which I found somewhat surprising when I discovered it, but I checked and double-checked, so I believe this to be true, is that imported goods are only 10% of the consumer's basket of goods in America, goods and services, excuse me. So housing, transportation, healthcare, insurance, education, all those things have much bigger weights. And when you think about it, how often does somebody buy, I don't know, a new television, for example, or a new washing machine? It's not that often. So I think that if the oil price suddenly went up $10, that would be much more detrimental to the U.S. consumer than these tariffs. And the market seems to feel that too. So the market could get a little rocky with the tariff talk, but I think that it realizes, and rightly so, that this is vast majority of it is noise and not that impactful.
And perhaps that could be the reason, and maybe the market gets proven right. Market's been rallying through and through, despite all of the trade uncertainty, Mark. So yes, we take your point on board. So what then? I mean, if for a second we park the tariff issue aside and expect it not to be as disruptive, like you described, otherwise all indicators have been holding up. Look at the jobs report. I mean, it was ripping higher above estimates. So would you expect further highs for the U.S. market in the months ahead?
Well, typically the summer, as you know, is a time when many people are not in the market, and so it can get less liquid. And typically when things are less liquid, they can become more volatile. And historically, you don't see good returns in the summer months. But there's a number of technical indicators we can look at that do suggest the market should be higher 12 months from now. One that I can tell you is that there were 5 other years since 1950 when the S&P went down in the first quarter and then rose 10% or more in the second quarter. And in all 5 of those, 12 months later, the stock market was higher. In fact, both on a second half basis, but also in each of the quarters, the third and fourth quarters of those years, the stock market was higher. There was never a down quarter. So for whatever reason, that's quite good. And then the golden cross, which is when the 50-day moves above the 200-day moving average, that happened on the 30th of June. And it doesn't work very well for prices that are volatile. But for the S&P, it has a pretty good track record. And if we go back to the 1970s, I think there was 25 times when there was a golden cross in the S&P, and in 22 of them, it was up 12 months later. So the technicals are telling us that we should be higher 12 months from now.
All right. Hi, Mark. Good morning. Good to see you. When we've got some comments coming out from President Trump. He's indicating that there could be an additional 10% on BRICS nations and no exceptions on that front. So India's at 10%. Another 10% would be around 20%. Do you think that's par for the course from an India market standpoint? Some were expecting a more favorable deal for India. Your view on that, and also where do you see the Indian markets headed? One would argue that relatively we're expensive, but otherwise earnings are expected to pick up from year on. So your take?
Well, I can't recall ever in my career talking about the importance of imports to the United States from India for the Indian economy. I never remember that coming up in conversations. It's not a driver of the Indian economy. What drives the Indian economy is its own domestic consumption. I really wouldn't worry about it. And the Indian market is fine. I think that the trend will remain, positive. The most important thing will be the earnings, which were disappointing last year, of course. So we need to see better earnings coming in from companies, and I think we will. I think it's a fine market. Nothing the matter with it.
All right, Mark, we'll leave it there for now. Thank you very much for joining us. It's always a pleasure having you here on the program on CNBC TV 18. Thank you.